right. 3, 2, 1, go.
Here we go.
All
Back
right. Again.
Yes. Seems like we're just here doing this a couple days ago.
We pretty much were.
Pretty much.
We've done a couple webinars. We've done a couple of things. If you guys are watching our show, well, you are watching your show if you're watching this. Make sure if you're, hopefully you're in our public Facebook group. We decided to do once a month. We're going to do a webinar for that group of people. Just kind of give them something in there to watch and whatever besides the show. Obviously, you don't have to be a member. You do have to be a member of the group, but you don't have to be a paid member of the site. But anyway, we're going to try to get better at like getting the word out for it. But once a month, we just did one, and so we'll have one in December. And we'll schedule it, and if you register for it, you get a replay link. If you don't register for it, you don't. So what I mean by that is, if it's at a time in a day where you can't watch it, go ahead and register for it, and then you can watch it after we post the replay, and you'll be good. But it's some good topics. We just did one on rolling over or not rolling over with your TSP, and I'm not sure what the next month's topic is, but if you have any ideas,
send them in. Absolutely.
Email us at webinars@growmytsp.com, and that's enough about webinars. What we got for this week?
If you are a member,
yeah,
you'll get the replay link.
Yeah, members will see it, because we'll have it on the site. They'll know no matter what.
Yeah.
But it's really geared towards the public Facebook group. But absolutely, we always share everything with members. If you are a member and you're wondering about that, you won't miss anything if you don't sign up. We'd like you to sign up and come, obviously, but this is kind of geared towards those that are not members, and it's just a little extra something. It's but members will always get to see everything.
Yep.
That's the point.
Okay. So, TSP Update Show, 21 November 2021. We got quite a bit to go over, and it's all kind of based on requests from different people that we've had over the last couple of weeks. We're going to change the Market This Week slide. It'll come out on Facebook. People seem to like that, so it's going to come out on Facebook after the close on Fridays, and we'll put the update in there of what happened on each TSP fund.
Yeah, we're not we're not yet at the close on Friday, so we're going to just save that info.
Right.
But it will be out, so don't worry about that.
Yep. Okay, so the show this week, I'm gonna say it's introduced. I used it last week, but I'm gonna kind of introduce it in terms of what the tool actually is. It's called Andrew's Pitchfork. So we're gonna go through and give some examples about how you can use Andrew's Pitchfork. It's a really good tool. One of the requests we got was, we're always doing Elliott Wave analysis of the C fund. Can we do Elliott Wave analysis of the S fund? And so, yes. So we're going to do kind of a long-term Elliott Wave and technical analysis of both the S and the I funds. The bonus chart is going to be Riot. And then we'll do the 2-year weekly charts. All right. Andrew's Pitchfork. If you go to the stockcharts.com chart school, this is this is the link for what we're going to be talking about over the next couple of slides. So stockcharts.com, go to the tab that says chart school and put in Andrew's Pitchfork in the search bar, and you'll come up with it. All right. This is what the tool looks like when you put it on a chart. Okay, it looks like a pitchfork. Or at least that's what the idea is. You got this first line and the second line, and then they extend out. So that's what it looks like on a chart. And here's how it was developed. So, developed by Alan Andrews. Andrew's Pitchfork is a trend channel tool consisting of 3 lines. You have the median line that goes that's parallel and equidistant from the 2 outside lines. So these lines are drawn by selecting 3 points, usually based on a reaction high or low moving from left to right on the chart. As with normal trend lines and channels, the outside trend line marks potential support and resistance areas. So a trend remains in place as long as the pitchfork channel holds. Reversals occur when prices break out of a pitchfork channel. So this paragraph is the introductory paragraph on the link that I showed on the last slide. Okay, let's go back to that and look at it for a second. If you remember the Elliott Wave count from back here at the low in COVID, we came up to a 1 right here, and this is the 2. So this is the swing high, and this is the swing low that I used to build out this Andrews Pitchfork. So you take the median, which is the third point, right? You have the median point, the swing high, and the swing low, and then the software extends out the pitchfork. So the idea is that as long as we're below the upper channel line and above the lower channel line, the price is going to oscillate through there, but we're in this long-term uptrend. Okay, so on a 18-month daily basis, until price gets below this lower channel line, the trend is in place, right? The trend is firmly in place. So this next paragraph is the conclusion paragraph in that post at Chart School. So the steepness of the pitchfork channel depends on the placement of the 3 drawing points, particularly point 1, which is the start of the median line. So even though point 1 usually starts with a reaction high or low, it's sometimes necessary to adjust point 1 to ensure a realistic price channel. Unfortunately, there are no hard rules for point placement. Instead, chartists must use judgment and experience when drawing channels. This is where the subjective nature of technical analysis comes into play. As with most aspects of technical analysis, it's important to build experience by experimenting with Andrews Pitchfork. Seeing what it does or doesn't work firsthand is the only way to really master the indicator. So what that's saying is there's no absolutes. So if we go back to the chart, we had identified this point as the 1 in terms of Elliott Wave. This was the 1. This is the 2. We're still expecting a 3 up here, a 4 down here, and a 5 up here somewhere. So this point is subjective because we called it the 1 based on the Elliott Wave. This move down here was the first major correction after this 1 move higher. So this became the first point we used. The swing low is the second point, and the median is really where it says you sort of use experience and kind of play around with it, because if you move this point back and forth a little bit, it moves the angle of the pitchfork. And so the way I built this, I played with this median line because I wanted to get the median line to basically be the median going through price, right? So you can see the highest points that we get, we don't quite get to the top of the pitchfork. We undercut it a little bit here, but basically the lowest points still stay within the overall pitchfork, but the majority of price oscillates along that median line. So for example, right now, I'm looking at the median line. If the market were to roll over here, I'm looking for support at the median line right here. Okay. So this is kind of the longest term pitchfork that we're going to look at. So the next one is the past 2 months. Okay. So in the past 2 months, we had the low on October 4th. We had a several-day run-up, which we called a 1 within this shorter-term pattern, right? We called this the 1. We came down for a 2. We said this is the 3. This is the 4. And we should be getting a 5 up here. We're still within this new pitchfork, right? So this is a shorter time frame pitchfork. We're bumping up against resistance here, and we've had support here for the last several days. And basically, we're getting support at the median line. So it's a great tool, right? If it breaks outside of those median lines, then the trend changed. It's a really valuable tool. Okay. It can work in both directions. So this is a 6-month chart of the C fund. This right here is the last chart that we looked at, right? It's the last couple of months. This is that Pitchfork, the low here in October, the swing high, the swing low. This is the last one that we just looked at. If we used it on the last correction, we had this high at the beginning of September. We came down and put in a low, reversed back up to a high. So there's our 3 points, right? We had a high up here. We had the first swing point, the second swing point. Draw the pitchfork, and you can see it keeps bumping up against the upper channel line. So as long as it can't get above that upper channel line, the market's in a downtrend. It broke out that day, but then really confirmed it the following day, breaking out of this downward trending pitchfork. So that's how, and it was coincidental to, not coincidental, but it was another way of looking at why we did an alert that day, because we confirmed a new change in the trend. So a pitchfork is just another tool that we can use, but again, it works both for the market trending down and the market trending up. All right, definitely go back and take a look at the link for the pitchfork. It goes into a lot more detail, but that's basically how you use it. Okay. The S fund, long-term, Elliott Wave, and some technical analysis. Not all, so we use a variety of tools, right? Elliott Wave gives us kind of a guideline for what we expect going forward, and we adjust the Elliott Wave count as we go. It's different. It's a different kind of a tool than moving average lines or trend lines or Andrew's Pitchfork, but we use a whole bunch of different tools, and you need to be able to apply the tools to what the market's doing. So in terms of Elliott Wave, this is the 16-year log scale of the S fund. Okay, so from where each tick is a month. So each one of these ticks is a month, and it goes back for the last 16 years. So here's the low in 2009. Right, that's the last major low. So if we counted it, this is the 1. So you had this first significant move off the low from 2009. And this was the first major correction. So you get the 1 and the 2. Okay. The count that I have 2 counts for the 3. You got 1, 2, 3, 4. And this is an extended 5. 1, 2, 3, 4, 5. That gives us the 3. And then COVID was the 4. And now we're in this 5 right here. Okay? That's one way of counting it. The other way of counting it is you got 1, 2, 3, 4, 5. So let's say this was the 5 and the 3 actually ended there. That's fine. And then you got A, B, C, which gives you the 4. So no matter how you count it, we're at a 4 at the bottom in COVID. And right now, we're somewhere in this 5. So in the big scheme of things, that's where we are in the S fund in terms of the Elliott Wave. If you look at it from a technical analysis perspective, this is a little bit different. This is a 16-year monthly, but it's not in log scale, right? It's log scale gives you a visual of the value of the move, the percent of the move versus just the number. So on the right-hand side here, the numbers, the prices are evenly distributed. If it was a log scale, from 400 to 800 is a 100% move. From 800 to 1600 would be another 100% move, but you wouldn't see it on the chart. So this is just to do technical analysis, not Elliott Wave, but you can see the 50-month moving average, the blue line. So we're still going back 16 years, and we have a lot of support at the major lows, right? COVID blew right through it, but we had a lot of support at the major lows at the 50-month moving average line. So that's a pretty important one to watch on a monthly basis. The other thing is when you get down to 20 on the slow stochastic, or really anywhere near it, it's signifying a major low. You don't get the same thing up here because when it gets above 80, it can stay there for a long time and price can keep going up. But when you hit these lows, it tends to be the bottom. And you can see right now there's a huge difference between what's happened since COVID and kind of how the chart, the MACD looked over the previous 14 years, if it's a 16-year chart. We've had a huge explosive move, both in terms of price and momentum in the last 2 years on the S fund. The other thing is 10-month moving average. So the long-term support you have at the 50-month moving average, right? The shorter-term support is the 10-month moving average line, the red line. And you can kind of see, even though the S fund has been doing what we've called this long-term consolidation since the beginning of the year, it's really just consolidated and given the 10-month moving average line time to catch up. And as soon as it hit that, it exploded off it and moved higher. So if you're looking at a 10-month chart, that 10-month moving average line is pretty important. Okay. So if we drill down a little bit, this is the 5-year weekly chart. Again, it's log scale. So you can kind of see the difference. The log scale, the distance between, let's see, from 1,000 to 1,200 is a 20% move. So the same distance would be 20% moves as you go along. So this is a 200-point move from 1,000 to 1,200. But up here, if you go from 2,000 to 2,200, it's also a 200-point move. But you can see that the distance here is much less than this distance, right? So the percent of gain here, even though it's the same number of points, the percent of gain here is much more than this percent of gain. So hopefully that makes sense. Okay. So this is just to drill it in a little bit. You can see this was we had a pretty big decline here in last quarter or so in 2018, but we had about twice the decline during COVID. And while we've got this sideways consolidation pattern on the S fund, it just gave that trend line an opportunity to catch up, and then once it hit it, it exploded higher off it, right, off that 10-month moving average line. Okay. I fund, we'll do the same kind of thing. We get the low here in 2009. We came up for a 1, a 2. You could look at it as 1, 2, 3, 4, and then 1, 2, 3, 4, 5, right? An expanded 5-wave there for 3, 4, and we're in the 5. So very similar to the S fund as far as that goes. Because you could also do the alternate count for that 3 was 1, 2, 3, 4. Oh, I messed up that count. Basically, this would have been the 3 like it was on the S, and then A, B, C for 4. But either way, you get to the 4 at the bottom in COVID, and we're in the 5 right now. In terms of the technical analysis, a couple things I wanted to point out about this. we use the 10-day moving average or the 10-week moving average, right, depending on which chart we're looking at, and we get support a lot of times at that 10-week or 10-day moving average lines, but a lot of times we don't. If you look at this section in here, there wasn't much value in really trying to trade along that line because it just oscillates up and down above it. So if you have gotten in and out, and you would have basically sustained a lot of losses over those years if you use that moving average line as what you were going to make decisions based on. So sometimes you have to adjust which tools you're using. That's all I'm saying. We're also getting pretty good support there at the 10-month moving average line. So kind of like the S fund. I want to go back to the iFund chart for one more thing I wanted to point out on this one. So we're back to the 16-year log scale. We have a top here in 2007 at about 56. And we got a bottom at about 22 in 2009. That's a little over a 60% decline. 60%. So that about 55 line, we keep hitting it, we keep hitting it. So if you had $100,000 in the iFund back here at the top in 2007, it took you, I mean, yes, we got above it here. We got above it here. We came back down below it. But you had basically no gains until halfway through the COVID recovery. So from 2007 to 2020, the iFund was flat. Pretty unbelievable. It was flat, meaning if you did buy and hold and you were in the iFund, you were flat for a long time. And now we're higher. But you were flat for a long time. Okay, we did the technical analysis on that. 5-year log scale also you can kind of see. There was a top. We gapped through the resistance at that top and kept on moving. So this gap up was pretty significant for the iFund. All right. Last thing about the iFund. We didn't do this chart for the S fund, but I just wanted to point it out. Back in 2003, at the low, the iFund was $17.50. 1, 2, 3, 4.5 years later, it's almost $60. It tripled. iFund tripled over that time. So Conan's always talking about how people were crying in their cubes back in the day. And I'm talking about how the iFund isn't always the lagger. Over the past 10 years at least, the iFund has been lagging the C fund. The CNS fund, everybody talks about your CNS for life. Back here from 2003 to 2007, the iFund tripled. We had a really clear head and shoulders here, and then the crash. And this is where people are crying in their cubes because they lost. If you were in here at 1750 and rode it all the way down to $22, it was a rough year and a half or so in here for you, and it took a really long time to get back. Okay. Yeah, one other thing. So the iFund triples from 2003 to 2007. The C fund, I don't have the chart with me, but the C fund, from the low in COVID, it was 2,200. So to double, for the C fund to double, was 4,400, which we hit in the beginning of October. So just to put things in perspective, the I fund tripled back here versus what the C fund did up here, it doubled. Just to say again, don't count out the I fund. When it's not really an if, it's a when. When the I fund starts outperforming, people will start saying, I fund for life. So, all right. Hopefully that gave some perspective on the Elliott Wave and the technical analysis for the S and the I. All right. Special request, bonus chart, Riot. So Riot Blockchain Inc. is a Bitcoin mining company supporting the Bitcoin blockchain through rapidly expanding large-scale mining in the United States. Riot is focused on expanding our operations by increasing Bitcoin mining hash rate and infrastructure capacity. Riot believes the future of Bitcoin mining will benefit from American operations and endeavors to be the driver in that future. So here's what a one-year chart of Riot looks like, a regular chart, not logarithmic scale. We're going to do the next one is going to be log scale. So huge move up right here, right in the beginning of 2021. Huge move. And then we came down, hit about that 40 line, came back up, couldn't make new highs, down to the 40, again, can't make new highs, down to 40, consolidate there a little bit, and then break below that 40 line. Come up, hit 40, can't get above it, can't get above it, can't get above it, but now we have higher lows, which is good. So now we're looking to get a breakout above that 40 line, and we didn't do it. It rolled over and went into this kind of long-term smiley face pattern, which is great. So once it broke out of that long-term smiley face pattern, that was ideally the time to get in it because clearly there's a lot of support and resistance along that 40 line. Unfortunately, it doesn't always work. So we had a fake breakout and it rolled over. So if we looked at that on a logarithmic scale, the moves, because again, the log scale, so from 5 to 10, you made 100% on your money, right? It doubled. So from here to here, Riot doubled. So if you look at it on a log scale versus a regular time scale, this was it back here. From 5 to 10, it doesn't look like much on a regular price chart. That's why if price is expanding a lot, or if you're looking at it over a long time frame, the logarithmic charts are way better to look at because you can see where the value actually is. But we also have the 40 line very clear on the log scale as well. And then we had that fake breakout and it rolled over. So long-term resistance at 40, we had the failed breakout. Riot was on the IBD leaderboard, but was removed this past Tuesday because it broke back down below that 40 line. Okay. All right. Tsp Fun Charts. So here's the weekly, 2-year weekly C fund. We've been looking at this for a while. We are well above that 10-week moving average line. C fund is still outperforming the S fund, but it's flattening out. All right, so right now the C and S fund are pretty much performing relatively similarly. And in terms of the count, 1, 2, 3, 4, and we're looking for a 5 up here. So once we get that 5, we'll see how things change, but we'll be overlaying the Andrews Pitchfork. I mean, if you can, picture where that Andrews Pitchfork is in here, this is kind of the bottom of the pitchfork. So, and this was the median line. So we're looking for support at the median line. If we don't get it, we're definitely looking for support at the lower channel line of the pitchfork. If we don't get that, then the trend changed. S Fund, huge breakout a couple of weeks ago and hasn't done much since. It's flat relative to the C Fund, still above its 10-week moving average line. This is a huge potential energy because we've been flat here since February. I definitely would expect the S Fund to move higher, but we'll just have to see. As long as it stays above its 10-week moving average line, it's good. And I Fund, same kind of thing. It's clearly underperforming the C Fund, has been for quite a while, but it's maintaining above its 10-week moving average line, and as long as it does that, I Fund is still, good to go. But in terms of being relative to the S and the I Fund, relative to the S and the C Fund, I Fund is not the place you want to be. F Fund has had a very tough run for the last few weeks. We talked about this before. We got lower highs all the way along, so we're definitely in a downtrend. We're looking at this bottom right here. If the F Fund breaks down below the October low, the next support level is the low back here. So, and we're also just about to cross over the 10-week moving average line is just about to cross over the 50-week moving average line. So I would say no reason to be in the F Fund at this point. And it's obviously way underperforming the C Fund. All right.
Questions?
Yeah. A lot of stuff in there, and it was quite technical, but we had a bunch of questions about, Elliott Wave patterns of the S and the I, and I thought Andrew's Pitchfork is a pretty valuable tool.
Yeah. So we focus a lot on the S&P 500, /C Fund, because, a lot of times that can be a leading indicator as to what's happening in the rest of the market, and it's the largest.
Yep.
This S Fund is a smaller portion, right, of the S&P 500.
Yeah, the of the 5,000 stocks that are traded, the 500 biggest companies are the S&P 500.
Yeah, and the S Fund. I'm sorry, I got that wrong.
Well, it's the 500 biggest companies. It's just that it's fewer companies than the S Fund, but they're bigger companies than the C Fund.
Yeah,
so,
I had it reversed actually. The rest of the market is the S Fund.
Right.
Yeah, 500 of those. They take a chunk of 500 and make the S&P 500. So, they're driving the market. Now, what we talk about all the time is there's 11 sectors basically within that S&P 500.
Yep.
That any one or two of those sectors are really driving it.
Yep.
And we
Definitely.
wish, and part of what we're hoping for is that this mutual fund window, when and if it comes to be reality, will allow us to dig into those sectors, because the overall S&P 500 could be kind of flat.
Right.
Or going up a little, and then there's a sector that's just exploding.
Yep.
Right.
Absolutely.
That's only making the larger index kind of gradually go up, but it might be going up 20-30%.
Right.
And if we had the ability to get down in there, we could make a lot better returns.
Yep. And that's true. And there's only 11 sectors, and that's still a conservative way to do this.
Oh yeah, still very conservative.
Yeah, because you're not buying individual stocks. You're buying the index of the sectors.
Yeah, you're buying a portion of this larger index. Yeah, I don't think we'll ever have the ability to buy single stocks within the TSP, so that won't be relevant for us. But even if we had that ability, we wouldn't be inclined to really do that.
No.
It's just too hard to keep track of so many things. Now, some people do, and they pour over all the fundamentals and they, do all that stuff, and that's great. But we think that the average government employee, military member who's got a mission that they're doing, and they're working their butts off, and they got family things, and they don't normally have time or desire to do all that. So you're better off kind of working with the indexes. The system they set up for us in the TSP is a really, stable, and, it does protect us from a lot of things. Now, we wish it was a little more flexibility in exercising those options, but, at the end of the day, you can't really ask for much. You talked about it, I think, when we did the webinar the other day on rolling over. We talked about the G Fund and how you think it gets a bad rap.
It does.
Right?
Yeah.
And so if you guys want, I'm trying to pull that clip out and kind of put it separate. It might take me a little while because I'll be traveling the next week. But that's a really good clip, a little piece there, nugget that you shared about how, the short version is that you can't find anything like the G Fund, meaning it can't legally go to, post a negative quarter,
Right. Right.
You always say the definition exactly.
No, it can't have a negative quarter by statute.
Right. So
by law.
So that's better than the average, savings account.
Yeah. I'm sure everybody knows your savings account right now isn't making almost anything. It's almost zero because interest rates are so low.
And the G Fund does make something, and we get a lot of naysayers particularly in our public Facebook group that are like, "Why would you ever go to the G Fund?" Well, how about when the market's trending down? How about that? How about then? So we do. That's what we do. Yep. That's part of our methodology. And why not go park it in some place safe and then come back into the game when it's trending up? Right. Anyway, if you listen to us all the time, that's just a broken record. You hear us talk about it. Yep. But a lot of times we have new people watching the show, so I like to throw in a little bit of that information. If you like the show, please share it with your friends. Really, what we would really like is if you commented, if you find this on YouTube or you find it on Facebook or you find it on our website, there's always a place somewhere to comment. At the end of the day, you can always send us an email at support@growmytsp.com, and we'll get back to you. They can route the email to us. We try to stay away from specific stuff. Don't ask us specific advice questions on your portfolio. But if you have, general questions about how to manage your TSP, we're happy to talk about it. We really love talking and having these discussions on Facebook. So, throw us a message. If you have an idea about a show topic, we've started getting people telling us which bonus chart they want to see. Yep. And that's kind of cool because it, gives Jerry some, he doesn't have to do as much research out there for something new. Right. It's, hey, someone shared it with us. Yeah. You got any final thoughts for us? Or?
Yeah, no, definitely. The more interactive that people are, the better the show will be. So definitely put comments and ask us questions and
we'd love to do a live call-in show, but the logistics of it is very difficult. So what we've decided to do, and we've kind of paused with these because we've been doing a bunch of webinars and different things, but we're going to bring them back, the Facebook Lives, where we kind of go live in the Facebook group, and that is kind of like a call-in show where you can ask us questions on the fly, and we love it because we love talking with you guys. Yep. We tried to do the show live like every Sunday night, and that just was very difficult for us, so that didn't stay that way. But we love it when you guys comment, and we always try to answer. Give us a little time, but we will. Yep. All right, guys. Hope you have a great weekend. Great week coming up. And again, if you like what you see or hear, share with your friends. We are out of here.